All right, so it's actually kind of crazy how these weeks go by. We are back to Saturday once again. We circle throughout last Saturday to this one, and yeah, time actually flies. So let's try to make it quick as far as I can. I was trying to put together some thoughts and charts, to be fair, but I was distracted on Discord. I admit it. It was really distracting. I don't know what happened. Apparently, I missed it, but there was some sort of a Olympic ceremony, opening ceremony in Paris that I completely missed, and now people are catching up to it, and it looks like it was a mess. But at the same time, in these days, it was a funny mess. So I'm sure the web is already full of memes and whatnot. But I'll try not to be and to get carried away now, but let's start out with some charts first and foremost. And we are gonna start from oil, I guess. Yeah, oil. And then, when you get down to indices, equities, and whatnot, we are gonna bring in a little bit of data release points, which have been going around throughout this week, and try to make a good assessment of what could it be, and a little bit of a larger topic on what the current situation is. A little bit of a follow-up to last week's video. If you remember, we were talking about the Trump trade and whatnot. So a little bit of that, but one thing after the other. Let's start out with oil. And if you remember, we closed down last week basically in here. Now, if you see the chart, is just a bit different compared to last time. But essentially, what I did is just to add in the EQ of this range, because if you remember, I said this sharp drop on Friday. It seems like it stopped right at the EQ of the range, so I took the previous range high, range low, I redrew it and added in the EQ, and you can see it actually closed in right at that level. Now, if you remember, I said I don't expect oil to move one way or the other in a very sharp fashion. Might be we consolidate a bit, and we might have a little bit of a carry on after this drop on Friday in the initial part of next week. We actually got it. You know, Monday, Tuesday, we got back down to range low. We bounced from here and we just tagged. Let's zoom in a little bit. We just tagged the AQ once again. Now, again, Friday, it was a particularly bearish close, and we closed out of the range. So, I mean, it's still in line with what expectations were. We weren't expecting the oil market to completely plunge all in one week, but a little bit of a consolidation. It looks like we had it. Range low was tested after the deviation higher. We retapped into the EQ and we have been rejected. So I guess at this point, considering we got one deviation to the downside, one to the upside, and then we broke back down, range low was retested, as we discussed. It looks like we might be in for a little bit of a bleeding down on oil. It could be. It could be. Now, it's not said and done. I always say markets, they don't move in a straight line, but they extend and then they draw back in, so but at least you can say that it took a little bit of a time. If you remember the usual chart we used for the break evens, it took a little bit of a time since mid-April when the break evens started to diverge from the price of oil, but with a little bit of a lag. And it is historically, it is usually 1 month, 1 month and a half, 2 months maybe, but with a little bit of a lag from mid-April. Eventually, oil price came back down. If you remember, mid-April, and then oil put in a top around, well, yeah, beginning of July. So a month and a half, and then you've seen the results. Okay, so this is oil. Let's move to Bitcoin real quick. I had a very good conversation about Bitcoin this week and all these behavior we were looking at. And I left the squiggly lines just for the sake of it, just to keep track of what could have been the developments in price action and how price action could have unfolded itself going on into the future. And what you say is basically what we were expecting kind of came to fruition, right? If you remember these theory, let's call it like that, because prediction is always an abused term, right? But we were thinking about a test of the apex above, and the initial test is usually rejected, and you have a little bit more of a push and a much more sharp rejection, and then you might see it going up finally after grinding into it a little bit, after chewing into it a little bit. So we got the initial test, a little bit of a rejection, then the deeper test, and a much more deeper reaction, as you can see in here, and we came back up in here. Now, the point might be to see if we can now hold these levels, and it doesn't have to be exact, but basically we could trade back down a little bit, maybe. But first and foremost, I'd say you could expect these price action now to take out the intermediate highs at this level and then maybe consolidating a little bit more and keep on following these price behavior of a slow grinding higher. That would be the thing. Now, I might delete it just for a brief moment to highlight a point. When we came back down, we basically touched in not only these point of release right in here, which was a very good response, as you can see, very sharp, very quick. This is the kind of response you want to see in a market which is trending with conviction in a particular direction. But it was lining up with these resistance level. So again, to highlight that the flip, it was resistance before, and then it was flipped. Now it's been flipped, and it's been confirmed as a flip 2 times. So the conversation was more about the timing of it, because I was reading some comments about, what, if it doesn't do XYZ in that amount of time, the odds start to actually shift to the other side. And I actually posted a question. What do you mean? I mean, how do you determine the amount of time which would be necessary? And all in all, I'll make it quick for you. Long story short, it's not really about the time. It's not like you can have a schedule on your calendar, but it's more about the price behavior, the dynamic behavior of price, because it's all a matter of liquidity. When you see a strong peak up like this and price moving sharply, breaking a fractal like this and actually flipping it, you would expect it to have continuation sooner rather than later, because it's just, as we say, and I know it's going to be maybe complicated for some folks, but this is usually what we define as trading strength into weakness. So basically, to give a little bit of a short version of it, when you have liquidity which has been picked up at this level and price actually showed and manifested intentions to go higher, you expect now this bulk of liquidity which was built up in here to slowly but surely give in compared to the strength which is coming out from the other side. And basically the logic is, if you see price actually struggling a lot or being stuck in this range in between here and not really being able to creep in, at that point you might start to think, you know what, I had this idea of price moving to the upside, but if it starts to stall a little bit, if it's really struggling, it might be that the liquidity on this side of the market, on the upside, right, let's say the selling pressure, it is still strong enough that it can't really be beaten. And we had a decent reaction off of it, but again, buyers showed up, and brought price higher back again in here. So, after the initial push and the rejection, now you say, you know what, the liquidity on the sell side, which was holding price down here, it is being eroded at these levels. So now what you would naturally expect is for price to continue this up move. And again, it might be choppy, it might not be a sharp move, but up until the point you see price confirming this behavior, although it might be, extension up, deep drawback, and then a reaccumulation, extension up. Until you see that, I'll say we are still good for Bitcoin to actually keep on trading higher. Okay. Quick look at yields. Now this time around, I'm not showing the ETFs on the bonds. I usually have the TLT and the others, but I mean it is the same time, since there is the inverse correlation. So showing these, it's basically just saying that the short duration bonds and treasuries are going up faster than the long duration. As you can see, the 2 year is really collapsing now, while the mid part of the curve is still going down, but at a you know smaller price increment, or at a slower pace. Let's put it this way. While the long end, it's still in this range. It looks like it's gonna follow up, right? It's gonna follow along, but it's moving a little bit slower. Now, there is still this whole thing about the convexity and price sensitivity at the long end of the curve. And again, if we measure the ultimate top in yields and where they are right now, they went down by 8%. If you look at the short end, let's see, just to check, yeah. Um, wow, 13. Hmm. You know what? I might have to take it back. Yeah. It looks like, at a point, this is really taking velocity. So, it might be that now we really start to see the short end really keep going and leaving the long end in the dust. It is part of the bull steepener scenario. So, I guess the long end is the one which is moving first, because it's just the part of the curve which is controlled by quote unquote the free market forces. The other one is a little bit more tied to policy decisions. But 2 years at what, 4.38, it is really signaling, especially to the Fed, that rates are too high. And we are going to get back to it in a little bit. I'm just going quickly through all of them before actually trying to get back to a few of them to pair it up with a few data points. Okay, let's have a look at gold. Gold, we were saying we got this deviation and we were to remain neutral slash bullish up until the point we could hold this fractal and the EQ of the range. Now, it looks like we actually tried for a run up, but it was quickly faded, and it was faded on Wednesday. Again, this is something which is linked to other assets, and we're going to look at it in a minute. And then at the end of it, I'm trying to build up a case for to kind of reconcile all these different movements. All right. So yeah, it was rejected. It came back down to the EQ, and it ended up the week with a bounce at DQ. So we can say the EQ held. And since this was your point of invalidation for a short-term bullish bias, that is not being broken at the current moment in time. Could this be different on Monday evening? Yeah, of course it could. But this is why you establish points of invalidation for your bias, just to handle yourself and your expectations. I don't have anything else in particular to say about gold. It's kind of stayed the same thing as for last week. If we can hold this, so well and good. If we crack it, we might trade around 2,300 and something. But I wouldn't, I don't know, I wouldn't put a lot of emphasis on it. Maybe the low part of the range at that point. Let's have a look at currencies because one of these four, I took it massively wrong, and it's just part of the game. I make mistakes all the time. I get things wrong all the time. If you talk with someone in financial markets and he goes like, "Oh, I'm always right," stay away from that person. Nobody's always right. But anyway, as for the Dixie, we've seen it trying these bounds. I was expecting to see, well, a little bit higher. I remember I said 104, 100, mid 104, right? Like in this pocket. We just got to 104 basically, but we did also say that if you look at the previous pullback, we didn't really fill in the inefficient leg, the weak leg down. So it could have been a consideration to make on this one as well. Okay. As for the rest, you've seen, as expected, the pound, the British pound, keep on pulling back a little bit. Same for the euro. But the surprise, I guess, was the yen for me personally, because I was expecting the yen to put together a little bit of a bounce. Um, well, I a little bit of a clarification. I say the yen when I do refer to the USD JPY pair or cross. But if you look at the others, I mean, it's kind of natural that in this one, the dollar is not at the denominator, it's actually the numerator. So when you see this cross going up, is the dollar which is gaining traction against the yen. When you see this cross going down, it's actually the yen which is appreciating against the US dollar. So basically, we've seen yen strength in this segment and throughout this week. While I was expecting the yen to actually be a little bit weaker, and so these chart to bounce a little bit back in this region. That didn't happen. So that's something that we got an expectation, and the expectation wasn't met. And again, bear in mind this behavior together with the gold rejection early in the week, because we are going to get back to it later on. So now that we have looked at the first part of the chart, we should transition in looking at indices, and that for equities for the US. Now, let's put it this way. Uh, let's take an overall look at what happened. And what we've seen is basically the same of previous week. The NQ futures were particularly weak. ES, again, they kept on going down. And on the other side, you've seen the Dow getting back to, well, kind of support and bouncing, especially on Friday. The Russell, at this point, it looks a little bit like a reaccumulation, although it could stay in this range for a little bit. So unless you see a sharp move higher to confirm this as a reaccumulation, for now I'd say it is a dealing range. Sure, it looks like it wants to go higher, but just wait for confirmation first. All right. What I wanted to incorporate in all of this was a little bit of the economic calendar. Now, what did we see throughout this week? It is basically, and we are just looking at what is related to the US, okay? So we are seeing that we got PMI coming out on Wednesday. Now, what I would say is that this was PMI global, okay? So it's not really so impactful for the US market alone. What do I mean by that is, if you want to seek for something which is really tied to the US equity market, you should wait for the ISM, because it is global, so it incorporates a lot of different metrics. It's not specifically related to the US. So I deemed it at the moment not particularly relevant, regardless what the outcome was of the release. Okay. What was more interesting was GDP for the US, which came out on Thursday, and it came out at 2.8. Now, what I would say about it is a little bit like the expected rate cuts for the year. If you remember, at the beginning of the year, the market was actually pricing in or expecting 7 rate cuts, and then it went down to two, then down to one, then back up to two, and now I think we are still around two and three from here to the end of the year. But just if you expand it, you can basically see, zooming in a little bit, that I guess the Atlanta Fed with this one, it is all over the place. All right. Now, I think you could still consider it as a downtrend, maybe. I'm trying to get a good angle. Right. Okay. Yeah, it's slowly trending down. Even if you include the revisions, it doesn't really change a lot. Okay. It's still a downtrend, so that should be testimony of economic contraction. So, still not recession yet, but at least a slowdown in the economy. And then we got on Friday the core PCE, which came in uh, around expectations. So that wasn't really a good surprise, or a huge surprise there. Basically, it was like that. Um, Again, this is coming down and is basically tracking the CPI at a point, maybe with a lag because all the different adjustments and all the different components of it and the different ways by which it is calculated, but it is kind of following the CPI as the nature of it would suggest. Okay, so these were the main economic uh, data points for the week. Now, let's try to incorporate a bit more. Now, if you remember the treasuries, right? We just have once again to look at the yield curve, and it looks like it wants to uninvert. Now, again, up until the point it's not uninverted, you shouldn't really be running for the hills, because you've seen the process of inversion. It was a little bit of a dip, then it came back up, and then finally it went for the inversion and stayed inverted. So it could be a little bit of the same in reverting this process. But it looks like, surely, slowly but surely, we are getting there. And the other economic data are actually suggesting a deterioration in the overall tissue of the US economy, following basically the global economies all around the rest of the world. Okay. Again, it is the cleanest shirt in a bucket of dirty shirts, right? So it might get there with a lag, but if the rest of the world is going fucked, it's very unlikely that the US can come on the other side unscuffed, right? That's the bottom line of it. Um, Another doom and gloom indicator right here. The If we can load it up, that would be much appreciated. Thank you, internet. The sum rule, which of course it's not up to date. It's gonna be up to date, I guess, next week. Yeah, it's still at 0.43. Next week we're gonna have FOMC and unemployment. So we are going to see if we finally get that 50 basis point magic number to trigger the rule, and saying that these recession indicators finally flashed the red light. Okay. Uh, I don't know. I guess we are gonna wait and see how it goes. But if you look at the trend, it doesn't look encouraging for now. So again, labor market expected to soften out a little bit more and more. One last well, it's not really the last, but anyway, one last chart. We might look at Fed funds from the CME futures to kind of have to grasp a little bit of a probabilities for a cut. As you can see, for the end of the month of July, the market is, considering the current rate, is this one from 5.25 and 5.50. The market, it's not attributing a high chance of cuts at the end of July, right? But it's putting a little bit more for the end, well, mid-September. So again, these September cuts, they are basically still on track. We'll see. We'll see. So for the end of this month, 93% 0.8 probability that the cuts won't come. And instead for September, you can see the current rate now. If you look at September, is this one, and you should have basically what, a 25 basis point cut in September, priced in at 88%, right? But let's look at what good old Bill Dudley had to say. Dudley said it might be too late for the Fed to stop the recession. And this is strange. I mean, it's not strange. We do know these policymakers. They are all arsonists in the beginning, and then they become firefighters, right? It is just one thing to note, because if you remember, Dudley was one of the most hawkish in 2020, 2021, saying the Fed needs to hike rates, we need to contain, we need to tame the inflation monster. Otherwise, it's going to come out of the closet, and it's going to be impossible to put it back in. And now he's actually advocating for a cut, because he says, well, basically what everyone is saying, that the economy is already stressed out enough, and we should try to gain a little bit of an edge as a policymakers to reduce the downside risk, basically to not overshoot. Okay, because you want to tame inflation, but if you go too far with your policies, which are meant to contain inflation, you risk the opposite scenario, which is deflation. And don't get me wrong, but these guys, they don't want deflation, mainly because it's not good for the economy, but it's way harder to inflate away your debt if you don't have at least decent or acceptable amount of inflation. Now, if you look at where Fed funds is for now, 5.33, and inflation is a what? CPI, if you want to take it as a proxy. I know there are websites like True Deflation and whatnot, but just going by the official data, inflation should be, on the top of my head, around 3%. I guess, yeah, last time it was down 0.3, so it went down to 3%. Yeah. So if you think about the real rates, 3%, and Fed funds is at 5 point something percent. And the bond market with the 2 years is signaling what? 4.3. Basically, if you combine all of it, rates are too high. It kind of ties in with what Dudley is saying. The rates are too high. The financial conditions are too tight for what the economy could sustain. And basically, that is supposed to mean that the Fed should start the cutting campaign. All right. Now, what could be interesting, it is, if you think about, if you as I discussed in a previous video, I guess it was, yeah, this one. You got to be fair with policymakers, because it's not an easy task. I said, look, it's not an easy position, the one in which Chairman Powell it is right now, because not only he might have some sort of a post traumatic disease syndrome, because he was wrong in saying inflation was transitory, and then it was not transitory. and then it was supposed to come back sharply, and then it didn't. It was sticky. They got it wrong massively too many times in the last 3 4 years. So now the last thing they need is to cut rates and then see inflation to be reignited. And then they have to hike rates once again, because it's all a matter of credibility for them. Okay, so what you're gonna do? I mean, I I wouldn't like to be sit in his spot right now. But I mean, at the end of the day, he was appointed, not me. So we could just assume he got what it takes to do the job. But spoiler alert, nobody has it, because if you look at the history of central banking from the 30s and the 40s, they don't know shit. Okay, but another fear he might have is that it is an election year. So, if you cut rates right now ahead of the elections, could it be seen as a way to sway voters one direction or the other? It, it could be. Uh, I know that, to me, it won't make that much of a difference whether they cut rates now, or if they did cut rates 3 months ago, or if they are going to cut in September or October or whatever you. But it is just how the public perceives that. So, because at the end of the day, when you think, does the old dilemma really count something? And my provocation would be, fuck no, it doesn't count shit. It is just a psyop, right? It's just a silly psyop, because the the core of the matter, especially when it comes down to the stock market, is not about rates being high, being low, real rates. Yeah, I do agree. You might say, okay, but that impacts the ability of companies to finance themselves or to roll over the debt, and therefore to maintain profitability and profit margins and whatnot. Yeah, I get it. But for the overall economy, everything is about confidence. And especially when it comes down to what is a little bit less related to the real economy, as the stock market, it is all about confidence. If you start to convince people that everything is good, and they are gonna behave like everything is good, they are gonna spurge more economic activity. And it becomes just a self fulfilling prophecy. I do things because I do things are good. I do things which actually make things good out in the real economy, and everything starts to be reignited again. If I do feel bad, I start to act like I do feel bad. I start to act like I do think the future is not going to be so bright, and I'm going to end up being the catalyst of the future not be so bright. That's all they care about. Go back to Ben Bernanke. He said that out loud. Central banking is 98% just talk. And more of that, most of that talks are just bullshit at the end of it. But, let's have a look at what happened. Now, I had this sketch for both, and forgive a little bit of a messy chart on the Nasdaq futures, but uh, this is the chart I usually look at intraday. So normally it's gonna have a few levels here and there, a few opens, a few stuff, which we're not going to get into it right now. It was just to highlight the breaking correlation we had in between the NQ futures and the ES futures. So what you can see is that starting on mid-July, basically, the Qs, or NQ, it started to manifest a little bit of weakness against the ES futures. And the how the whole thing unfolded itself is that if you look at just first expecting support, NQ touches it, tiny little bounce, and it smashed through it. Okay, while if you look at ES, first anticipated support held a much better bounce, then okay, eventually it got through. But if you look at the lower levels, it's just the same thing repeating again. A good support, anticipated support level right in here, right? And if you look at the cursor of my mouse in here, it's basically the same as in here. The timelines are the same. It was support coming off of mid June, same as here, right? ES had it, uh, bounced from it, should I say, while NQ, it just cut through like it was butter. And finally it found a little bit of support in these fractal. This is lower fractal right here, but you can see it's much more weaker. Now you might say it's just the nature of the asset. It is much more volatile. It went up the most, so it's coming down the most. And then you got the old feast about the Trump trade, semiconductors crisis with Taiwan because we don't want to defend Taiwan, so people are trying to reprise the old earnings dynamic in the big caps and the tech sector. Yes, maybe, maybe not. But if you look back at mid-July, did we had already in mid-July all these narrative coming around? A little bit of it, maybe, but it unfolded itself later on. But the market was already showing that one sector was weaker than the other. So, it's just a tiny thing you can pay attention to. So these breaks in correlation, they can help you in establishing, once you have a bias, let's say you're bearish, the bottom line is I want to be short the NQ futures rather than the ES, just based on that. All right. It's just a measure of relative strength at the end of the day. And that was repeating throughout the week because even if you look at these, and that was July 19th, July 19th was here, right? You see that these pullback on ES went much higher than these intermediate high, while on NQ, this pullback it didn't went higher from this intermediate high from July 19th. This one did. So it repeated the same pattern. You got a high high and a lower low, just a little bit below it. So, just especially if you swing trade, just bear it in mind. Could be helpful in the future. Who knows? Now, having a look at the ETFs, I think the again is a little bit of a repeating theme. Just last time it was about a 20-day moving average with ES, right? We kind of held around it at first test, then we smashed through it, and now it looks like on the 50 we kind of held at it at first pass. Now we need to see if we are gonna hold it. From just taking the opens here, from top to the recent bottom, I was a little bit, almost a 5% correction, more or less. While if you look at the yes, from the top to the recent bottom, 9%. Uh, could this be? Could this be all well and good now? If you remember the first video I posted, I'd, I'd say, I said, this is a place where I would like to be a buyer. Now, whether you want to be a buyer for the long to mid to long term, whether you want to be a buyer for a scalp, intra-week or intraday, this one gave a very good reaction. I mean, price actually jumped 2% from here. So, I mean, at the end of the day, it wasn't that bad. I was thinking the same about ES, or SPY in this case, but we didn't get there. We just reacted to the previous anticipated support, a little bit above it, which fits in with the narrative that ES is currently a little bit stronger than the Qs. All right. So all in all, this these were the behavior for the week, and what we've seen were the data which came out for this week. Now, I'd say we're gonna wait for the end of the month to see what comes out of FOMC, and then we will try to reassess. But the I guess you know the message at the end of the analysis, the charts and the data and the logics behind the yield curve, rates, Dudley talking, the old thing about central banking being psyop and the market actually moving on confidence as the economy a little bit. I guess the at the end of it, what could you ask yourself is, so what comes first? What is most important? Sentiment or price action? Because you see people talking about sentiment, you see people looking at sentiment indicators and whatnot, and there is this belief that when sentiment is particularly extreme on one side or the other, what you get is a move in the opposite direction. It's the old analogy of too many people all loaded up on the same side of the bus, and then of course the bus take the other direction. But one counter argument might be, yeah, okay, so if you look back, it was 1997, 1998, I guess. I was just reading about it. Back then, going into the dot-com bubble, right? Sentiment was so high. And yet, the market kept on going higher for another 2 years plus. And eventually it crashed, right? But I think, and this is my personal opinion, okay? You don't have to agree, you don't have to disagree. I'm just trying to throw it out and say and see if someone might actually find a little bit of a value into it or might think about it in a different way, okay? When when do you see sentiment actually shifting? Because in my experience, both intraday and on a larger time frame, my take on it is the sentiment shifts when price action suggests that sentiment should be shifted. In other terms, people might be as bullish as they want, and then the market all of a sudden it drops 10% in 1 week, and everyone is panicking. But what did cause the sentiment shift? The sentiment was a all-time high. Everyone were bullish, right? And all of a sudden they turned bearish. Why? Because if the market would have kept on going higher, everyone would have just remained bullish. So I subscribe to the theory that it is price action which dictates the pace and the state of sentiment. When you have a shift in the flows, and again, it doesn't matter, it might be the 1 minute chart, it might be the weekly chart, but when you have a shift in the flows which are hitting the books and price action responds accordingly, then you're going to see sentiment shifting around because it is just a matter of psychology. We do feel good up until the point things are going good, or at least we see what might resemble like things going good. We start feeling bad when we see things going bad. So that would be my take on it. So at the very least, if you are one of those which are following the sentiment indicators, I would take them as, a little bit of a warning light, right? you know, you take it, you keep it on the back of your mind, and you think, you know what, sentiment is at is all-time highs, right? So I need to be nimble now because as soon as I see price action shifting one way or the other, it might be that sentiment shift will come soon after, and all of a sudden we are going to shift from buying the dips to selling the rallies, to fade the rallies, right? So this is the dynamic I would attribute to this dichotomy in between sentiment and price action. To me, price action is always king. All right, but that doesn't mean that you should completely discard sentiment indicators. They can help in assessing potential risks, but just because they can signal something, it doesn't mean that it's going to come next day or next week. It could take another few months. You never know, which is why price is the ultimate harbinger at the end of the day. So that is my view on it. A little bit of a side note, you might say, okay, you know what could be another thing to add on top of it? the commitment of traders report, which ties in a little bit with this thing about people being on the same side of the bus. It's like if you see old people which could have bought, if they all have already bought, who's left to be a buyer? And what happens when you go out of buyers? If the market can keep on going higher, it's gonna have to come back lower. It's just it's just another interesting dynamic you see in markets. If they can sustain the move higher, they're gonna have to come back down and seek liquidity, uh, buyers. I say liquidity because I'm constantly talking about liquidity, inventory, and whatnot. But it's the same thing. If you can't find the liquidity, aka the buyers, which are propelling the move higher at a point, you're gonna have to find them lower. If they are not showing themselves at these levels, price will need to go down to seek for buyers. It is just basic supply and demand. It works for financial assets, it works for goods and services in the real economy. It is just at the core of everything at the end of the day when you think about it. Then you can call it supply demand, you can call it liquidity on the sell side or the buy side, you can call it leftover inventory, you name it. Labels, I'm not interested in labels, to be fair. You are you want to call it Johnny? Or be my guest, call it Johnny. It's not an issue as long as you know the dynamics which are implied in these movements, and in these uh, all these moving parts being combined together. Names are kind of irrelevant at a point. Okay, so we are gonna close in, and yeah, I'm gonna take it below the 1 hour mark. Yeah, um, I'm actually becoming good. We're gonna close in, uh, circling back to what we were looking at as for the yen and a little bit for gold. All right, and we are gonna look at gold, the yen, and what is it? And what happened on indices. Now, what you see here is that the big drop was on Tuesday, right? So let's see if it lines up. Tuesday, big drop on the Qs. Tuesday, big drop on SPY. Let's take a look at gold. Tuesday, not really, but Wednesday, so close enough. Good amount of rejection in here. Let's look at the USD JPY. Monday, Tuesday, big leg down. So why am I looking at it? Because I was trying to build up a case. And the case is that these sharp down move, beside being the potential result of just an LT, an organic correction, in an overall uptrend, right? But being so sharp could also be the result of someone, as in the market people used to say, someone blowing out. Now, what do I mean by that? If you think about the big guys, someone called them the smart monies, whatever, but let's just call them, for the sake of simplicity, let's just call them hedge funds. Hedge funds are highly leveraged in this market. And of course, in order to beat an ideal benchmark and to retain investors and then for clients, commissions, and to make a living, they need to at least being kind of in line with the benchmark at the end of the year. So they're going to try to lever up what they got in order to maximize return. Now, it's no surprise and it's no secret that if you look at the yen right here, and let's just, where is it? It should be this one, this one. And if you look at the yen over the past, well, over the past year, let's say, if you want to fund yourself, whether it is to invest in your company or to acquire the funding you then need to buy equities or commodities or whatever you, If you have the yen, again, remember the numerator, denominator thing. If you have the yen getting so weak against the dollar, why wouldn't you borrow in yen, in the yen denomination, and then swapping those yen for dollars and then going and buying US equities? Why not? Okay, is the infamous carry trade. You finance everything you got with yen because the interest rate is basically zero for the longest time. And at the same time, the yen is depreciating against the dollar. So it's a win-win. Not only you don't pay a lot in terms of interest on the loan you took out, but when you pay back the loan, you pay back in a currency which has been devalued against your local currency in the US. Makes sense, right? But if you have a sharp move like this and the yen, it's all of a sudden it's rebounding, might be that carry trade it starts to unwind a little bit, even if it is a short-term thing, right? It doesn't have to be something which it's gonna go ahead for weeks and months. But even if it is a short-term thing, if the amount of leverage you took in is so high, it might be that you start to receive, I don't know, margin calls, or maybe your local bank actually calls you and you know what, sir, you need to put up more collateral if you want to maintain these trades on the long side open, because this and that happened in those yens funding positions you got, and now you need more collateral to keep them open. And on them you built up other positions on other assets, so everything starts to unwind from the bottom up, right? And at the same time, I guess these hedge funds, they got a lot of them. I would assume they were long on the mega cups, but at the same time, they were most likely probably short on something like the Russell or the industrial sector because they were really not doing anything. So if you combine all these things together, the carry trade, which is a little bit, again, in the short term, I'm not calling for macro reversal on the USD JPY pair, but consider the amount of leverage in the system or in between these actors, these financial speculators, right? If you got something like this happening all at once, you're short these two, they go up. They need to cover the shorts. You're long these two, they go down. You need to close the longs. What do you do when you close a long? You basically have to sell. And if you are reporting a lot of losses, you might have to chase these assets down, actually opening short. What could you do? If you need to put up more collateral, hmm, I wonder what could be the one thing that always catches a bid. There's always a bid for gold. So it might be that you liquidate a little bit of your positions in gold because they have been performing very, very well over the last few months, if not year, in order to cover up a few losses you are reporting in other sectors of your portfolio. Could this be? Maybe. I mean, it's just another thesis. It's just another idea. What now, if it makes sense or if it doesn't, this is all up to you. I'm just throwing it out there. What could be cool about it, okay, is that if you wanna keep on looking at the old structure of the equity, especially the majors in the US, these deleveraging events, they are usually sharp, but they are quick. They don't really last too much. So if you want to label it as a one-off, and from here we might put in a decent bottom and then trading again back higher, of course discarding any type of, as we discussed in the beginning, some rules, unemployment, Fed cut, a bank wherever blowing out, the banking system crashing, but everything else being equal as it is right now. So if there are not any further deteriorations, would you might say that an unwind like that could be just short-term lived, and then we can get back to the user schedule with uh, big cups and majors going higher, and the Russell and the Dow actually mean reverting a little bit. Could this be? I guess I mean, it could be a case, could be something you can build up, and then you see if actually it starts to unfold, and if it does, you put money back in the stock market. That's the cues, and spy, and it's all well and good. I mean, at the end of the day, in an uptrend, 5 to 10% correction, it's not bad, especially throughout the summer, the election year, whatnot. Credit spread are relatively tight for now. The the real junk bonds, the spread in between them and the others, it did widen up a little bit, but the other tranches like the A's, the triple A's, you're not seeing particularly any sign of stress in those ones. So I don't know. As I said last week, I'm not ready to call a macro top in this market yet. So at the end of it, take it as it is. It is just my idea. Could I change it next week? Yeah, maybe. Getting back to it, sentiment is just a result of shifting in price action. So if I see something in price action which convince me that you know what, maybe I was wrong. I need to reevaluate, to reassess my state and my stand, my statement, and my stand. I'll do it. And this is just what a trader does, what an investor does. We don't know the future. We can just try to follow the trail of the market. That's it. So I hope it was interesting a little bit. Uh, I'm gonna wishing you a very good weekend, and as usual, have fun and be cool. Neil's out once again.